Canada's new inflation report that came out this morning. And while it does look like pretty good news on the surface, if you look a little bit beneath that surface, it's a little bit more complicated. Inflation has dropped, but what's really behind the numbers? I'm going to break that down in this video today. Here's the headline. Canada's inflation rate fell to 1.7% in April. That's down from 2.3% in March. That's also the slowest pace of price growth we've seen now in 7 months. Analysts were expecting an even lower number, about 1.6%, so it came in just slightly above that. The biggest driver this month, a decline in energy prices. They were down 12.7%. That compares to a smaller 0.3% decline that we saw in March. But what's really relevant here is that the drop isn't necessarily a sign that inflation is cooling across the board. That's the key. A big part of the decline this time around, it comes from the pre-election move by Prime Minister Carney, who temporarily removed the carbon tax on energy products. And that cut in itself, that directly lowered gas and heating costs, and that pulled the headline inflation number down. Meanwhile, though, core inflation. So this is what economists really pay more attention to. That actually rose. When you strip out the volatile sectors like food and energy, prices actually climbed 2.5% in April, and that's up from 2.3% in March. And this is where it gets even more important. Two of the Bank of Canada's preferred inflation gauges, this is the CPI trimmed mean and the CPI median, they both moved higher. The CPI trimmed mean, that rose to 3.1% in April, up from 2.9% in March. That's the highest number now in 13 months, above market expectations. The CPI median, that jumped to 3.2%, also above forecast, and that is now its highest reading since March of last year. So both of these measures are well above the bank's 2% target. The key to these numbers is that these gauges are designed to filter out the volatility and to really focus and shine the light on the underlying trend. So while the overall numbers, those headline numbers, while those look cooler, the underlying price pressures haven't gone anywhere. In fact, as we just saw, some of those are quietly heating up a little bit. This puts the Bank of Canada in a really tough spot. The next interest rate decision, that's coming out in a few weeks, middle of June, and they're going to be weighing these two competing realities. On one hand, you've got the headline inflation. It looks like it's easing, but the stuff that really matters, the core costs, we're not seeing any sign of a let up there. As we see, the CPI median and trimmed mean both climbed above that 3%, so the bank is likely to treat the lower headline number sort of as a temporary distortion, especially given that carbon tax suspension and the role that that plays. That could delay any plans to cut interest rates, or it could even lead to a more cautious stance in their forward guidance. The bank has made it pretty clear they want sustained progress on inflation. When you look at these numbers here from their perspective, these core measures, they are definitely flashing a warning sign with that bump up above 3%. Now, there are some other warning signs in the economy as well. It's not just inflation that is raising concerns. When we look at Canada's real economy, it's showing strain. The unemployment rate, that ticked up to 6.9% in April. Manufacturing sales dropped 1.4% in March. And some economists now are predicting a mild recession. I've read up to 100,000 more job losses are expected by fall. That's obviously not good news there. Now, when you look at consumer behavior in the road ahead here, interestingly, consumer spending has held up quite well, at least for now. Retail sales were up 0.7% in March, and that's largely because a bunch of shoppers probably rushed out to buy vehicles and other high-ticket items before the new tariffs kicked in. So what do we look at next here? Well, if inflation continues to cool at the headline level, if we see energy prices stay low, then the Bank of Canada might consider easing rates a little bit later this year. But we can't ignore this. With both of the CPI median and the trimmed mean at those multi-month highs, and if core inflation and wage pressures remain sticky, while at the same time we're seeing those job numbers continue to weaken, then the Bank of Canada policymakers, they might need to just hold off or at least rethink their strategy. And these are all real challenges. The big question isn't, is inflation falling? It's what kind of inflation is falling, and more importantly, what kind of inflation isn't falling. And right now, the kind that really matters to the Bank of Canada is still at an uncomfortably high level. Do you have thoughts on the whole inflation thing? Let me know what your thoughts are in the comments below. Now, today, the finance ministers from the Group of Seven, the G7, they're meeting in Banff. And the main goal here will be to calm these sort of rising trade tensions that have been reignited under Donald Trump's return to office. We've heard this before. The U.S. wants to spotlight what it calls unfair trade practices, especially by China. But others in the group also want to dial down all of the tariff conflicts that we've seen lately. This is a 3-day meeting, and it will set the stage for the bigger G7 Leaders Summit, which happens next month in Kananaskis. The three main items on the agenda this time around, global economic resilience, Ukraine, and of course, trade strategies. Now, John Curtin, he's the director of the G7 Research Group at the University of Toronto, and he says it gives a chance for all of the finance ministers to have very frank discussions and make their point individually and collectively to Scott Bessent about the cost the tariff war is imposing on Americans in the United States. Notably, this is the first full G7 finance ministers meeting in over 6 months, the first with U.S. Treasury Secretary Bessent. And he wants the group to focus on readdressing the global trade imbalances that we've heard so much about, what Washington sees as harmful non-market practices, especially coming from China. Now, a Treasury spokesperson for Bessent, he is pushing a back-to-basics approach that targets economic spillovers from these non-market economies. Meanwhile, here in Canada, our Prime Minister Carney, he is pushing for a pivot away from U.S. dependency, and the goal is to strengthen trade ties with Europe and with Asia. During his recent trip to Rome, Carney said that critical materials from Canada will be part of that push. He said, Canada has what the world wants. Now, Curtin, he does agree that Canada needs to prove it has real alternatives to U.S. trade, especially as this Trump-era tariffs, they remain a threat, even though they are currently paused or scaled back somewhat. Now, there is wide G7 consensus on confronting China's state-driven subsidies, trade manipulation, but it's unclear whether members will be supportive in their stronger actions. But we know for sure whatever happens in Banff, that will definitely shape the expectations for the G7 Leaders Summit in June, where these same tensions are going to be playing out. Now, my last story today is Home Depot. And Home Depot delivered a very solid first quarter performance. They posted $39.86 billion in trade. That came above analyst expectations of $39.31 billion. But what really stood out in this report was the company's decision to keep their prices unchanged. They specifically said that this is a goal even though tariffs are threatening to push their costs higher. And that is a very sharp contrast to Walmart, which I spoke about last week in this program. They warned last week that rising tariffs could soon mean higher prices for customers. Now, in response to that, President Trump, he lashed out at Walmart. He strongly criticized them. He said the company should eat the tariffs instead of passing the costs along to shoppers. Now, Home Depot CFO Richard McPhail, he says, we anticipate that 12 months from now, no single country outside of the United States will represent more than 10% of our purchases. We intend to generally maintain our current pricing levels across our portfolio. Now, by comparison, when you factor in the Walmart decision last week, Home Depot's pricing decision here, that seems aimed at projecting stability to both customers and investors, and even in this turbulent trade environment that we're living in these days. They have been slowly reducing their dependence on overseas suppliers, especially China. Today, the company says it sources less than half of its products from outside of North America. And that shift, that will help insulate them from the trade shocks, and it puts them in a stronger position when you compare it to its peers. Overall comp sales, they slipped 0.3%, was slightly worse than expected, but the company did maintain, importantly here, its full-year outlook, projects sales at 2.8% of growth for fiscal 2025. It says it's continuing to see strong demand from pro contractors. A weak spot, though, DIY demand is softening as homeowners are delaying larger renovation projects like bathroom and kitchen remodels. That'll be a wrap for today's show. As always, appreciate you watching. Go ahead and subscribe if you're not a subscriber already, and we'll see you soon in the next video.